Imagine earning crypto rewards from mining or staking, thinking it's just passive income. Then, you get hit with an unexpected tax bill for an extra 15.3%. Sound like a nightmare? For many crypto enthusiasts, it's a harsh reality. The IRS might see your activities as a trade or business, not just a hobby or investment. This can trigger a significant self-employment tax. In this video, you'll learn exactly what self-employment tax is, how the IRS determines if your crypto activities are a business, the crucial difference between active validators and passive delegators, and how to correctly report your crypto income to avoid penalties. We'll cover everything you need to know to navigate crypto self-employment tax in the 2025 tax year. Let's dive in. So, what exactly is self-employment tax? If you've ever freelanced or worked as an independent contractor, you might already know this pain. It's basically the Social Security and Medicare taxes that employees and employers usually split. But when you're self-employed, you're on the hook for both halves. The IRS says the self-employment tax rate is a combined 15.3% on your net earnings. This breaks down into two parts: 12.4% for Social Security, which applies to earnings up to a certain limit. For the 2025 tax year, this limit is $176,100. Then there's an additional 2.9% for Medicare, and that one has no income limit. 4. This 15.3% one is on top of your regular federal and state income taxes. For a profitable crypto miner or validator, this can be a huge and often very surprising tax liability. The big question is, does your crypto activity count as a trade or business to the IRS? The entire self-employment tax issue hinges on this one concept. Are you running a trade or business? The IRS doesn't have a super clear definition. Instead, they use what's called a facts and circumstances test. It's not a simple yes or no. According to IRS Publication 334, a trade or business is generally an activity carried on to make a profit. 5. But it's more than just wanting to make money. To be considered a business, your activity needs to be conducted with continuity and regularity. A one-off transaction or a casual hobby won't qualify. The IRS looks at factors like your profit motive, how regular and continuous the activity is, the time and effort you put in, and if you run it in a business-like manner, like keeping good records. If your crypto activities tick these boxes, you're likely running a business. If not, your earnings are probably just investment or hobby income, which isn't subject to that 15.3% self-employment tax. 1. Crypto mining is one of the clearest examples of a trade or business in the digital asset world. Think about it. A serious mining operation isn't just someone casually running a computer. It involves significant upfront investment in specialized hardware, like ASICs or GPUs. There are ongoing costs for electricity, cooling, and maintenance. Miners often run their rigs 24/7 to maximize block rewards. Plus, there's active management of hardware, software, and mining pool participation. Someone running a single old GPU in their basement might be seen as a hobbyist. But if you're operating multiple mining rigs with the clear intention of generating consistent profit, you are almost certainly running a business. Income from mining must be included in your gross income at its fair market value when you gain dominion and control over the coins. If you're running a business, this income is reported on Schedule C6. Staking is where things get a bit more nuanced than mining. Whether your staking rewards are subject to self-employment tax often depends on your role. Are you an active validator or a passive delegator? This distinction is crucial. Let's break it down. A validator in a proof-of-stake network is actively involved in the consensus mechanism. They run a dedicated node, propose and validate blocks, and secure the network. This requires technical expertise to set up and maintain the node, significant capital risk through locked tokens that can be slashed for misbehavior, and active 24/7 management. On the other hand, a delegator simply commits their tokens to a validator run by someone else. They don't run any hardware or software. Their activity is much more passive, similar to earning interest or dividends. This difference in activity level is key to the tax treatment. If you're running a validator node, you're an active participant. You're not just holding tokens, you're providing a service to the network. This role demands technical expertise to set up and maintain your node software and hardware, capital at risk, because you're locking up a significant amount of tokens that could be slashed if you mess up, and active continuous management to keep your node online, secure, and performing its duties around the clock. Given this continuous effort, the technical requirements, and the financial risk involved, running a validator node strongly resembles a trade or business. The rewards you earn are seen as compensation for these services rendered to the network. This means your income from validating is very likely subject to that 15.3% self-employment tax, 1, and should be reported on Schedule C6. Now, if you're a delegator, your situation is quite different. You're simply committing your tokens to a validator that's run by a third party. You don't have to run any hardware or software yourself. Your primary action is choosing a validator and delegating your stake. This involves minimal effort and a much lower technical barrier, essentially just basic wallet use. For delegators, staking rewards are usually classified as investment income. You're providing capital to a service provider, not actively providing a service yourself. This income is still taxable at ordinary income rates when you receive it, but here's the good news. It's typically reported on Schedule 1 of Form 1040 as other income 7, and crucially, it would not be subject to the 15.3% self-employment tax 1. This is a significant difference for your tax bill. Beyond traditional mining and staking, new on-chain activities are creating even more tax questions. Take MEV, or maximal extractable value. Searchers who use sophisticated bots and strategies to capture MEV are engaged in high-frequency, complex activities. This level of effort and intent strongly suggests a trade or business. Then there's airdrop farming. Systematically performing numerous transactions across multiple wallets just to qualify for potential airdrops could also be seen as a business, especially if it's done regularly and with a clear profit motive. A casual user receiving an unexpected airdrop is very different from a dedicated farmer. For all these activities, meticulous record-keeping is absolutely essential to support your tax position. Tools like dTax can help you track all these complex transactions across 22 supported blockchains and apply the correct cost basis method from its 13 options, including specific ID. The 1099-DA Reconciliation Center can also help you match broker-reported income against your on-chain records. Check out gettax.com. It's open source and free to start. The form you use to report your crypto income is absolutely critical, and it all comes down to that trade or business determination. If you're considered self-employed, meaning your crypto activities are a trade or business, you'll report your gross income from mining or validating on Schedule C, Form 1040, profit or loss from business 6. This is also where you deduct all your ordinary and necessary business expenses. The net profit from Schedule C then flows to Schedule SE, where that 15.3% self-employment tax 1 is calculated. However, if your crypto earnings are deemed investment income, like for passive delegators, you'll report them on Schedule 1 of Form 1040 as other income 7. This income is still taxable, but it avoids the self-employment tax. Knowing which form to use can save you a lot of money and headaches. Let's tackle a couple of common questions about crypto self-employment tax. First, can I deduct expenses if I am considered self-employed? Absolutely. If your crypto activity is a trade or business and you report on Schedule C6, you can deduct ordinary and necessary business expenses. This includes things like electricity costs for mining, hardware depreciation, software subscriptions, and even professional fees. These deductions reduce your net profit, which in turn lowers your self-employment tax and income tax. Second, what if I have both staking and delegating income? That's a great question. You might have to split it. The income from your active validator node would go on Schedule C6, subject to self-employment tax. The income from your passive delegated staking would go on Schedule 1.7 as other income, avoiding that extra tax. It's crucial to keep clear records for each type of activity. The biggest takeaway here is that not all crypto income is treated equally by the IRS for miners and active stakers. That 15.3% self-employment tax 1 is a real possibility, but understanding the trade or business test and proper reporting on Schedule C6 versus Schedule 1.7 can make all the difference. Don't wait until tax season to figure this out. If you found this video helpful, please give it a thumbs up and subscribe for more crypto tax insights. And if you have questions, drop them in the comments below. Thanks for watching, and I'll see you in the next one.